Hello traders, so we are in chapter 2, defining a price range. So in this lesson actually we're going to be looking at how to define a price range. So the importance of a price range is actually knowing where the market is and where it is likely to go. So this is the risk disclaimer, you can read it. So what is a price range? So essentially, a price range is a predefined range from high to low in price action that is relevant to the current market conditions. So essentially you want to have a high. So in this example you have a high and a low that we're defining based on what the market was doing in this scenario. So this market was initially dropping, so it was probably maybe dropping into a key level. So once it hit that key level, then we're starting to see a retracement. So we define that as our low and we define this as our high. So that is the range we'll be working on to maybe determine entry opportunities either to buy or to sell once it gets into these levels. So I've used actually a fib here. I think I showed you in your TradingView tutorial. So I showed you how to define this fib ranges. So these are the ones we're going to be working with. So we have actually the 0 level, then we have the 1. So those are just showing highs and lows. And then we have, so I actually defined my fib from this high to that low. Then we have the 50%, we have the 62%, 70.5% and 79%. So those are the levels I'll be focusing on, or rather we'll be focusing on. So the 50% is actually the equilibrium of the range. So that's a very actually important level in price action. So there are 3 points in any price range. So we have the equilibrium, the one I've mentioned, very important because it now defines our price range and it helps us to determine where we are within the scope of the price range and the market. Then we have premium. So premium is essentially anything above the equilibrium, and then discount is anything below the equilibrium. So as I've said, we have 3 major points in any price range. We have the equilibrium, which is the 50% of the price range. This is a fair value price. We'll be looking at fair value in future lessons. So premium is any price above the equilibrium of the price range, and discount is any price below the equilibrium of the price range. So when you look at an example, so we had a range high and a range low down here, then we have the equilibrium. So this equilibrium will show us whether we are in a discount or a premium, because from that equilibrium we will know that anything below is discount and anything above is premium. So this levels actually that I was outlining, we have 62%. This is a level in premium that is usually very sensitive to price. So once price has gotten into premium, you want to be looking for selling opportunities. So, and then we have 70.5 and 79%. So this is 70.5%, 79%. So this ultimate premium actually is that I don't like price to go beyond when I'm looking to be a seller, because once it goes beyond it, it's very likely to take out this range. But we have other instances where price might go all the way to this range, take out this high, and then reverse. So it highly depends on the daily bias and the weekly bias. So looking at the equilibrium, actually as we have outlined, this is the 50% of the price range, and it is a fair value price. Fair value meaning that the market will typically want to revisit this area of the price range. So for example, we have range high to low, we have the equilibrium. So once it got to that low, the market will typically want to come back and revisit that area. So that's why I'm calling it a fair value price point. So it will revisit this equilibrium, and then typically you'll see the market now resuming, maybe going lower. So, and essentially you don't want to see it spend too much time here, because once it hits this equilibrium, and if it goes beyond the equilibrium and hits any of these levels should find actually sensitivity immediately. You don't want to see the market spend a lot of time there. Then looking at the premium, this is any price above the equilibrium of the price range. So once you have outlined the equilibrium of the price range, anything above is premium. So this is where actually you typically want to be selling from to the next discount level. So for instance, in this example we have equilibrium, so anything above is premium. So once it gets above the equilibrium, it can give you an entry opportunity anywhere above it. It could be the 62, 70.5 or 79. So you can't really always know which level it will be, the market will be using, but you can use lower time frame to determine if the market is standing at any of these key levels. So these are high probability sales actually residing here, because you want to frame your sell entries from premium rather than from discount, because you want a price point that is already showing that the market is overbought up here. So once it hits any of these levels and shows willingness to go lower, you want to target the next discount level, which could be this low down here. So that is essentially how you use the premium. Then looking at the discount, this is actually any price below the equilibrium of the price range. So in this instance we have this as our discount, and you'll be framing high probability buys down here. So once you have a price range, you have the equilibrium, and you're in discount, you want to be looking to be a buyer into the next premium level. So if you took a buy, say down here, you want to maybe exit at the equilibrium or any of these levels, because the market will likely find sensitivity and react to go lower. So why do we even need to know this premium and discount levels? I'll say that the most important thing is that you want to ensure that you get the most optimal price point to either buy or sell in the marketplace, because once you get that optimal price point, then you're getting into a market that is ready to move. So you're not entering the market and waiting and hoping that the market will move. You're entering in a place that the market is most likely to move from. That's why we're defining this premium and discount levels. So when bullish, actually I'll recommend that you consider buying when the price is at a discount or just below equilibrium. So we may get into any of these levels down here, but essentially you want to be a buyer below equilibrium price point. So if you have divided a range like this and you're bullish, so when the market now revisits this area, anything below equilibrium, I think I like 62%, because it mostly hits that. On occasion it might not really get down to 79 unless you have a really key level that it is seeking for. So you want to be entering anywhere in between 50 and 62. That's your entry, and then you exit at the next premium level. So the market will typically not spend a lot of time below equilibrium. It will want to run as fast as possible away from that level. So that's the reason you're saying that you frame your entry there, and then you want to see immediate response from those levels. When bearish, you want to consider selling when the price is at a premium or above the equilibrium. So for instance, we have a price range here. Though when the market was coming up, we have the equilibrium right here. So you see in this instance we got into 79%, and then after hitting that level, we want to be a seller up there, but already we might have taken either at 50 or 62. So you don't really need to aim for the highest point or the lowest point it will get to, but just aim for the high probability place where it will most likely reach for. So once it hits that, you want to be a seller, and then you target the next discount level. So actually guys, that is the bulk of the lesson. So you want to now start going into your charts and doing a few of the exercises I'm going to outline here. So number one, you want to go into your charts and identify the price ranges and its parts as outlined in this lesson. So when I say its parts, I mean identify the equilibrium, identify the premium and the discount levels. Also, you want to outline the price range relevant to the time sessions and the day of the week already taught. So for example, you can go into London session and outline the price range formed during London, and then you might get that New York might revisit the equilibrium of London's range. And you can also look at the New York range. You might find maybe the next day you'll revisit that range and you'll say that price will be reacting or at those key levels that we've outlined. So look at examples of either London and New York and how it retraces back into the ranges. And also look at how it responds once it hits the equilibrium, just above it or below it. You want to be recording this in a journal. So record and back test. Do a lot of back testing and see how it pans out. So thank you so much for watching. So I'll see you in the next lesson.